Hi everyone, and welcome to the bi-weekly EcoInvestment update for June 21st, 2015. I guess it should say tri-weekly because it's been 3 weeks since I did the last update, but there's been so much stuff going on in the rancho with renovation and restoration and garage roofing, and now there's more carpentry in the future. It's just busy, busy, busy all the time, but that does not mean that things have not been interesting in the market. So I thought today we would drill down on the stock market because, as you guys know, for the past 4 to 5 months it has continued to fluctuate in this range from about 17,600 to 18,250, back and forth and back and forth, and people are starting to get frustrated. So the reason that the thing I want to talk about today and drill down on is, why do markets stall at certain levels, and why do they reach levels where they just can't seem to go on? They don't lose ground, they don't make ground, but they just they do these consolidation periods that can last for years and years and years. The period from 1974 to about 1982 was a historically very long consolidation period where the market basically did nothing at all except to hang around the same level until finally exploding out on a new move in August of 1982. Well, I kind of expect the same thing to happen here, although unlike most people, I still expect the resolution to be on the upside of that move, because interest rates are still quite low. It's quite low. So then, what's the holdup? Why aren't we moving forward? Well, it seems like each time the market starts to make a step forward, it gets caught up in a new drama. For example, you could go all the way back to the Ukraine situation with Russia, and then we went on to the potential collapse of the Japanese market. Now the problems with Greece are coming to the forefront again. Will Greece or won't Greece be able to pay its debts? And if it doesn't pay, what are the implications? And you can see that anytime that the market has a little bit of stumble or a little bit of political worry, the bears are quick to jump on that and try to press the market down. But of course, they can never keep the momentum going for very long before the bulls take up the charge again and move upward. The thing that's taking place now is the market's looking beyond Greece. That's just a cover story of what's going on in the news now. The real battle now is the market's digesting higher interest rates and what they may mean for the market going forward. Remember, if you're new to the channel, we've had one working thesis for the past 2 years, and that's low interest rates are the driver of this bull market. And as long as they stay low, and as long as the alternatives are few and far between for investing your money, i.e. CD rates suck, money market rates suck, bond rates suck, what's the alternative? Well, people are putting their money into stocks. The reality is, though, that people are also watching interest rates, and as interest rates move higher, at our low point, I think we were at 1.59%. Not 3 or 4 months ago. Now we're like at 2.3%, 2.2, 2.3%. It doesn't sound like much of a difference, but percentage-wise, it is big. So the people that are in the market day to day and studying it very carefully are very nervous about what this means for the stock market future. Of course, you and I know, as students of market history, that a 1.5% to 2.25% interest rate is not a heck of a lot of difference in terms of alternatives being available to invest your money in. So consequently, the market does not give up much ground here. And as I said, the reason being, what else are you going to do with your money? But it still makes people kind of nervous. But look at it this way. As money starts to move out of the bond market, the interest rates are going higher, and especially on people that have been invested in long-term bonds, they don't want to see their capital values erode or decline as interest rates climb. Now, what does that mean? When you buy a bond, and let's say it comes in at $100 or $1,000, it's quoted in hundreds units, it's $1,000, and let's say it comes out, well, if interest rates rise 10%, that bond yield's going to have to rise too to match that, and the capital value, the market value of the bond is going to drop accordingly to create that higher interest rate. It's an inverse relationship. Interest rates go up, bond prices go down. But since people are now worried about interest rates rising, and most of the big run-up and most of the juice has now been sucked out of the interest rate move, some people are smart enough to realize now this could even add more potential fuel to the stock market as people now start to evacuate from the bond market and looking around for alternatives as they always have. CDs suck, money markets suck, stock market continues to be the only game in town that just seems to still be on an uptrend, albeit a very halting and patience testing one. So what do? We hang tough. That's what we do. We trust that the long term will resolve itself in the way that it came into the consolidation. That is to say, the market rose and now it's been going in this motion for 4 to 5 months. So we trust that the next move will be continuation out of that consolidation pattern and sweeping higher. You know, it's not easy to make money in the market. It's very easy to be spooked by headlines. And every little tick of news feels like a hurricane and all that. Well, you've got to keep your eye on the prize. You've got to keep your investment thesis simple. And that's exactly what we do here. As long as interest rates remain low, the stock market will continue to rise. Also, as long as the stock market is not threatened by rising interest rates on the part of the Fed, then the market will rise too. They're scared to raise rates. They might talk a good game and jawbone things, but at the end of the day, they're very nervous about the impact that raising interest rates could have on a very, very fragile economy. And no way Janet Yellen ever wants to be known as the goat that caused a big calamity on Wall Street. I'll see you in 2 weeks, guys. Have a wonderful 4th of July. I guess that's about when we'll see you next, the 4th of July. So have a wonderful start to your summer. See you then. Thanks.